Welcome back to The Deep Dive. And for those of you enjoying the long holiday weekend, happy July 4th, 2025.
Happy 4th.
While many of us are maybe thinking about barbecues and fireworks right now, the global trade scene is actually seeing some pretty big shifts.
Yeah, definitely some headline-grabbing stuff happening.
So today, we're going to dig into President Trump's latest tariff push. It's pretty aggressive.
And the timing, too, right? Over a holiday weekend.
Exactly. We want to look at what that surprising timing might tell us about the strategy behind it all.
Right. So our goal here is really to cut through the immediate noise of these announcements.
Get past the headlines.
Exactly. We want to pull out the crucial details, understand the impacts, both immediate and maybe longer term.
Give you a clear picture.
Yeah, a clear picture of this whole trade situation, which is changing fast. We'll unpack the numbers, the key deadlines, what's happening country by country.
All based on the sources we've got in front of us.
Absolutely. A, the shockwave begins, a holiday impact.
It really is something, isn't it? Announcing there's huge trade moves on July 4th when, lots of people aren't glued to the news.
Yeah, markets are closed.
So what does that timing tell us? Is it about avoiding an instant market reaction or maybe sending a message like, we don't stop, even for holidays?
Well, I don't think it's accidental. It feels like a deliberate strategy, maybe to maximize leverage. Because the really critical date here is July 9th. It's coming up very quickly.
Right around the corner.
And time has basically run out for a lot of U.S. trade partners. They needed deals done before that date, or tariffs snap back, higher tariffs.
And the sources confirm that deadline is solid.
Oh, yeah. Yahoo Finance reporting on July 4th makes it clear this deadline is firm. It's all about applying pressure.
So it's not just talk, it's a timed rollout, and action is already happening.
That's right. Letters apparently started going out on Friday, July 4th.
On the holiday itself. Wow.
Notifying countries of these new tariff rates. And some of them are pretty eye-watering.
And when do these actually kick in? For businesses, that's the crucial part.
August 1st. That's the effective date for paying these new duties.
Less than a month away.
Exactly. So this isn't just a threat anymore. It's a concrete plan moving forward right now. Companies involved in trade with the U.S., they need to figure this out fast, logistically, financially.
And it's such a shift, isn't it? I remember earlier reports like Bloomberg mentioned on July 4th, there was talk of scores of deals. Optimism, even.
Right, with more than 170 trading partners. That was the language.
This feels different, much more unilateral, less like seeking deals, more like dictating terms.
It really does. The characterization is stark. Take it or leave it.
Right.
That's what sources are calling these letters.
Sent just days before that July 9th deadline.
Right before the deadline for those sweeping tariffs laid out back in April. It feels less about partnership, more about hardening the U.S. position. Use the clock to get concessions.
It's like a high-stakes game of chicken.
Pretty much. Push partners to decide fast.
And you can feel the ripple effects globally. Everyone's watching.
Oh, absolutely. Yahoo Finance said the policy reverberates around the world. It's not just the countries getting letters.
Every trading nation is looking at this, thinking about their own economy, how this changes things.
It sets a precedent, the speed, the timing. Businesses, governments, they have very little time to react.
It's almost like weaponizing uncertainty.
That's a good way to put it. Forcing quick decisions, potentially disrupting trade routes, manufacturing bases. It signals a real shift in how the U.S. plans to engage. B, the 70% gambit. A deep dive into the numbers. B, the 70% gambit. Pause, point fours.
Okay, let's talk about that number that's really jumping out. President Trump saying tariffs will range in value from maybe 60% or 70% tariffs to 10% and 20% tariffs.
Yeah, that's 70%.
70%. I mean, that's huge. Almost unheard of in modern trade, right?
What does that really signal? Is it a negotiating tactic or a real threat?
Well, that's a big question, isn't it? Trump apparently told reporters about 10 or 12 letters going out Friday. It's just the first batch.
With more coming over the next few days. The goal, according to Bloomberg's report, is that by July 9th, countries will be fully covered by the new rates.
Fully covered? Wow.
No. So the speed, the high numbers, it points to applying massive immediate pressure.
And Trump can still grant extensions, right? So that adds another layer of uncertainty.
Exactly. It weaponizes that deadline even further, keeps partners guessing, feeling the heat.
And just to be clear, that 70% figure, that's way higher than what was talked about back in April, right? The Liberation Day stuff.
It's significantly higher. Back then, the max mentioned was 50%.
So this is a real escalation.
That figure.
Which raises the question, who gets hit with that 70%?
Right.
Which countries? Which products, did he say?
No, he didn't elaborate on the specifics. And that ambiguity itself, is probably part of the pressure strategy. Keep everyone on edge.
What do we know about the lower end, though?
Well, Treasury Secretary Scott Bessent mentioned something. Yahoo Finance reported him saying around 100 partners would likely see a minimum reciprocal rate of 10% come next week.
Okay, so a floor of 10% for many.
It suggests a broad application, yeah. Even if not everyone gets the extreme rates. Bessent also apparently expected a flurry of deals before the deadline.
So they anticipate some countries will concede at the last minute.
Seems like it. But again, Trump has the final say on any extensions. So the pressure stays on right until the very end.
Okay, so a wide net being cast, maybe some extreme cases. Let's pivot now to the specifics, country by country.
Yeah.
Because that's where you see the real impact.
Right. Let's start with China.
China. Okay, this one's interesting. Amidst all this tariff escalation, we're seeing some easing of restrictions on ship design software. Companies like Synopsys, Cadence, and ethane exports, too.
Yeah, it seems counterintuitive, doesn't it?
It really does. What's going on there?
Well, Yahoo Finance, again on July 4th, framed it as a sign that tensions might be calming on specific fronts. Part of a framework for that larger deal they agreed on back in May.
So, like, targeted easing even while the broader pressure stays high.
Kind of looks like it. Maybe strategic concessions on specific high-tech areas where cooperation or stability is needed. It also seems linked to China's own recent concessions on rare earth exports.
Okay. So a specific de-escalation there.
Seems that way.
But China didn't seem happy about the Vietnam deal we're about to talk about. They reacted strongly to that, right?
Oh, very strongly. Opposing deals made at the expense of China's interests.
And threatening resolute countermeasures. That sounds serious.
It does. It shows that while there might be tactical easing in some areas, the core competition is still fierce. China sees deals that might shift supply chains away from them, especially to neighbors like Vietnam, as a strategic threat.
So it's geopolitics as much as economics.
Absolutely. Their threat of countermeasures means they're ready to retaliate if they feel cornered or undermined. It's a complex game.
Okay, let's talk Vietnam. So they got a deal announced. 20% tariff on imports to the U.S. That's lower than the 46% threatened initially.
Right, lower than threatened. But there's a catch. A much higher rate, 40%, for transshipping goods.
Transshipping, explain that. What exactly are they targeting there?
Yeah, this is key. It's aimed squarely at goods that originate elsewhere, mainly China, but are routed through Vietnam to try and dodge U.S. tariffs.
Like trying to disguise the origin.
Exactly. Sometimes it involves relabeling, minor processing stuff to make it look like it came from Vietnam. The 40% rate is designed to make that completely uneconomical. Force transparency.
And in return, Vietnam gave something up.
Big time. They agreed to slash import taxes on U.S. goods to zero. That's a major concession.
But is the deal finalized? I heard there was still some uncertainty.
That's right. Reports say negotiators are still working to finalize the details. So there are still a lot of questions for businesses trying to figure out how this actually works on the ground. It's not fully buttoned up yet.
And Vietnam's role has grown massively, hasn't it, in U.S. trade?
Hugely. 10th largest trade partner overall, 7th largest source of imports. Their trade surplus with the U.S. just exploded. Over $123 billion last year.
Wow.
And already over $50 billion just through April this year. So you can see why the administration is focused on them.
And companies like Nike, Lululemon, they've moved manufacturing there, right, away from China.
Exactly. Vietnam's been a big beneficiary of that supply chain diversification trend.
So this transshipping tariff is directly aimed at stopping China from using Vietnam as a backdoor to avoid U.S. tariffs.
That's precisely the goal. Shutting down those loopholes. It shows how complex this gets. Companies chasing efficiency, governments trying to enforce rules.
Okay, moving on to Japan. Here, the news doesn't sound as positive. Negotiations have soured.
Yeah, that's the word being used. Trump is apparently threatening higher rates now, 30%, 35%, or whatever the number is.
Higher than the 24% mentioned before.
Yep, higher than the Liberation Day level. It's a definite escalation.
And the language used.
Pretty blunt. Trump apparently called Japan very tough and very spoiled in the talks. That suggests things are quite tense, not looking like an easy resolution before July 9th.
Even for a close ally like Japan.
Seems like no one's immune if the trade numbers don't look right to the administration, especially with Japan's big surplus in auto exports.
What about the European Union? Are they closer to a deal?
Well, They seem more willing to bend, perhaps. Sources say they might accept a 10% universal tariff on many exports.
10% across the board.
On many things, yeah. But they want exemptions. For pharmaceuticals, alcohol, semiconductors, commercial aircraft, key sectors for them.
Protecting their high-value industries. Makes sense.
But Trump had threatened 50% on the EU before. So 10% is a big step down from that threat level. Talks are apparently continuing through the weekend. It's crunch time.
Is there pressure from within the EU to make a deal?
Oh, absolutely. This is fascinating. Big European companies, Mercedes-Benz, LVMH, others are reportedly pushing hard for a quick deal by holding back-channel meetings with U.S. officials. Basically going around the official EU negotiators.
Wow. So corporate pressure is weakening the EU's official stance?
It certainly looks that way. Bloomberg noted it's weakening the European Union's efforts to stand up to Donald Trump's tariff threats. Shows how immediate business concerns can influence diplomacy.
Economic reality is hitting hard.
Definitely. These companies face huge losses if high tariffs hit. Their self-interest is pretty clear.
Okay, how about Canada? Closer to home.
They seem to have made a key move. They scrapped its digital services tax. That was a major sticking point with the U.S.
So that clears the path for talks.
Looks like it. Talks have resumed, and their goal is reportedly a deal by mid-July.
But are there underlying issues there?
Well, the data shows something interesting. Canada's share of exports going to the U.S. actually shrank in May, down to about 68% from almost 76% last year.
That's the lowest since
1997, if you exclude the pandemic weirdness. So maybe that's adding urgency for them to secure a new deal. Trade patterns are shifting.
And we saw the impact on German cars earlier. Tariffs really do bite into exports.
Absolutely. Those German car export drops 13% in April, 25% in May are stark examples.
Let's look at Indonesia. They made a specific offer.
Yeah, quite specific. They offered to cut duties on key U.S. imports to near zero.
And also
buy $500 million worth of U.S. wheat.
Okay, so market access and a big purchase.
A strategic package deal. Indonesia faces a potential 32% tariff otherwise, and they had a nearly $18 billion trade surplus with the U.S. last year.
Is there more to it?
Yes. Apparently, their state airline, Garuda, is buying more Boeing planes, too, as part of a larger $34 billion pact set to be signed next week. It's a comprehensive effort to smooth things over.
Shows the lengths countries are going to. What about South Korea?
There, things sound uncertain. President Lee Jae-myung was quoted saying, "It's still not clear to each side what the other side wants."
That's not ideal with the deadline so close.
Not at all. Especially for South Korea, their economy is incredibly dependent on exports. Shipments abroad are equivalent to over 40% of their entire economy. So they are extremely vulnerable to tariffs.
Especially on things like cars, semiconductors, batteries.
Exactly. Major exports for them. Any big tariffs would hit their GDP hard and fast. So this lack of clarity must be causing a lot of anxiety there.
And finally, India. What's the holdup there?
The main sticking point seems to be dairy and agriculture.
Farming. Always sensitive. Why? Particularly in India.
It's deeply political. Agriculture is only about 16% of India's GDP, but it supports almost half the population. Millions and millions of small farmers.
So opening up to U.S. farm goods could be destabilizing.
Hugely. U.S. farms are vastly larger, more efficient in scale. Think average farm size. Just over 1 hectare in India versus 187 in the U.S. Dairy herds. 2 or 3 animals versus hundreds.
Big difference.
Massive. Flooding the market with cheaper U.S. imports could devastate livelihoods and cause huge political problems for the government. Remember the farmer protests.
Right. So that makes negotiations very tricky.
Extremely. Trump had threatened 26% on Indian goods, but lowered it to 10% temporarily for talks. So there's pressure, but also maybe some room to negotiate around this sensitive issue. C. Navigating the tariff storm. Actionable insights. C. Navigating the tariff storm. Pause. Point 4s.
Okay, so that's a whirlwind tour of the global situation. Given all this intense activity, the threats, the deals, the deadlines, how are markets actually taking it, especially with U.S. markets closed for the holiday?
Well, leading into the holiday, sentiment was actually pretty strong. Surprisingly robust, maybe.
The S&P hit a record high.
Yep, hit a record June 27th, went higher still. And interestingly, investors don't seem too worried, at least not yet, that these tariffs will spark a big wave of inflation.
So maybe seeing it more as negotiating noise than immediate economic disaster.
Could be. Or maybe a belief that deals will get done, like the Vietnam one, softening the blow. The market seems relatively calm about it for now.
And we also got that positive jobs report just before the holiday, right?
Exactly. Employers added 147,000 jobs in June, beating expectations. Unemployment ticked down to 4.1%.
That must help sentiment too. A strong domestic economy can maybe absorb some friction.
Sure. And recession odds have plummeted. They were way up at 66% back in early April, now down to just 20%.
Wow, big drop.
Yeah. So the market relief seems tied partly to seeing deals get made like the Vietnam one.
Yeah.
Evercore ISI even suggested more deals like that might be coming. India, Indonesia, others using it as a template.
So the narrative is more deal-making than trade war right now for investors.
It kind of feels that way, yeah.
Okay, let's connect this to specific sectors. Which areas are feeling the heat already or are most exposed if deals don't happen? Where should you be looking?
Well, luxury goods is definitely one to watch. We mentioned Watches of Switzerland warning about profit margins.
Right, because of U.S. tariffs.
Yeah. They said some brands are already raising prices or cutting distributor margins. That tells you something. High-end discretionary items often feel it first.
And it's not just consumers paying more, the whole supply chain adjusts.
Exactly. Reduced profits for businesses, potential shifts in market share. It's complex.
What else?
The auto sector, clearly. We talked about those big drops in German car exports to the U.S.
13% in April, 25% in May.
Yeah. And the German Auto Industry Association is pushing hard for a deal. It hits complex supply chains, parts makers, dealers, everything.
And Canadian exports shrinking too.
Right, down 4 months in a row in May. So these are real measurable impacts happening now in major industries.
So for listeners trying to navigate this, what are some, actionable ways to track this or maybe think about hedging?
Okay, we'll take commodities. They had Indonesia deal mentioning U.S. wheat. That's a direct signal.
Beyond just wheat futures.
Yeah, maybe look at basis risk in different agricultural commodities. Or options contracts to hedge against volatility if more deals like that happen or fall through. You're looking for shifts driven by these political moves.
And the chip software easing for China?
Could signal things for related tech commodities, maybe rare earths, though that's complex.
And with all this uncertainty, volatility must be a factor.
Oh, definitely. The whole situation screams implied volatility. You could look beyond the general VIX index, maybe options on specific tariff-sensitive ETFs, or even individual companies with high export exposure.
Checking the options pricing for sentiment.
Exactly. See what the skew tells you. And, defensive currency pairs, yen, Swiss franc, sometimes strengthen in these situations. Currencies of heavily impacted countries might weaken. Those could be hedges.
And for stock screeners, what should people focus on?
Stick to the sectors we've seen impacted in the sources. Luxury retail watches of Switzerland is one example. Look at others. Autos, especially German, maybe Canadian manufacturers, check their U.S. residue exposure.
And semiconductor.
Yeah, semiconductors.
Yeah.
Given the China easing affecting Synopsys cadence and South Korea's huge role and vulnerability there.
And just keep reading the news.
Pretty much. Keep an eye on dashboards, financial news outlets like Yahoo Finance, Bloomberg, the sources we used. Look for trade news updates, economic calendars, tracking negotiation dates. Stay informed. D, your questions, our insights. Pause. Point fours.
All right, we got a great listener question that ties right into this. Someone asked, how could these new tariffs influence the Fed's next rate decision?
Yeah, that's the million-dollar question, isn't it? How does this feed into monetary policy?
What do the sources suggest?
Well, Rick Newman over at Yahoo Finance had some commentary. He noted the Fed is watching closely. And if inflation doesn't really materialize from these tariffs...
If costs aren't passed on widely...
Right. Then the Fed might resume gradual rate cuts later this year.
Right.
Which could provide a bit of an economic tailwind. So inflation is the key they're watching.
But that strong jobs report we mentioned, didn't that change the immediate outlook for cuts?
It absolutely did. Another Yahoo Finance piece on July 4th basically said a July rate cut is now completely off the table because of that solid jobs report.
So strong jobs push against cuts right now.
Exactly. The Fed has that dual mandate, inflation and employment. Strong jobs suggest the economy is resilient. Less need for immediate stimulus via cuts.
But the tariffs are still a wild card.
A huge wild card, because they could still spark inflation if costs get passed through. Or they could dampen economic activity if trade slows down significantly.
So the Fed's stuck watching the data.
completely data dependent. The strong jobs report argues against cuts now, but the potential impact of tariffs keeps them cautious. They're looking at everything: consumer spending, capital flows, supply chains. It's a very dynamic situation.
So, bottom line for the listener, no July cut seems likely now, but the Fed is absolutely monitoring these tariff effects closely for future decisions.
That's the gist of it. It's a complex equation they're constantly reevaluating. Outro.
And that just about wraps up our deep dive into this pretty intense week of trade news. President Trump's July 9th deadline, that 70% tariff threat.
Yeah, and all those ongoing negotiations, the country-specific deals and sticking points.
It really shows how global trade dynamics are shifting, putting pressure everywhere, impacting specific countries, specific industries.
And if this much significant news breaks over a holiday, it makes you wonder, doesn't it, what else is shifting under the surface when maybe fewer people are watching?
That's a good point.
Kind of encourages you to think about the longer-term implications, right? These take-it-or-leave-it policies. What do they mean for supply chains, for consumer prices down the road? These deadlines could really shape the next few years or even decade of trade.
Well, it is July 4th, so let's hope some traders are actually, touching grass today, maybe enjoying some fireworks instead of just staring at charts.
We can hope.
Okay, standard disclaimer. Remember, this deep dive provides information and analysis from our sources. It is definitely not investment advice.
Please consult professionals for that.
If you found this deep dive valuable, please subscribe to the deep dive wherever you get your podcasts. We're also on Spotify and YouTube with more in-depth analysis.
Pick us up there.
And don't forget our weekday closing bell live stream for real-time market insights as things happen.
Thanks, everyone, for tuning in, especially on holiday.
Yeah, thanks for joining us for this special July 4th deep dive.